Welcome everyone to our webinar on Franchisor Compliance Update Code Obligations from November 2025. It's been a big year for franchisors, and that certainly shows in our registrations for today. So there's going to be a lot of information we go through. My name is Nick. I am one of our legal solutions consultants here at LegalVision and will be the host of today's webinar. I'm also joined by Cameron Graf and Annalise Catania, who are practice leader here at LegalVision. Cameron and Annalise is one of our senior lawyers who will be running you through the content in today's session. Before we begin, a couple of housekeeping items for the webinar. So the webinar itself, the recording and the slides will be issued to your registered emails following the completion of the webinar. As we proceed through the webinar, there is a Q&A box that you can access at the bottom of your Zoom panel. Any questions that you have and would like to have addressed at the end, please send them through there, and then we will have a session for that at the end. And then lastly, at the end of the webinar, you will receive a feedback survey. Really vital and important for us. If you can share us what you enjoyed through the webinar so that we can continue to make these as important and as useful as possible for you. By viewing this webinar, you are eligible to receive a complimentary consultation with LegalVision to discuss how we can help your business. To claim this webinar, leave your contact details in the survey that appears when the webinar ends, and one of our team will be in touch to book that in for you. Now, I will hand over to Annalise, who will run you through the agenda for today.
Perfect. Thanks, Nicholas. So today we'll obviously be going through the changes from 1 November, but we'll kick it off just a snapshot of those changes that came in April, what you should already be complying with, and the key facts there. We'll also share after this webinar the link to our early webinar, which goes into those in depth. We'll talk through those compensation for early termination and reasonable opportunity for return on investment provisions that we'll be applying from 1 November, as well as the specific purpose fund clauses. And then we'll go through, the ACCC current enforcement actions and the commentary we've heard from them. So to get started, a recap of kind of what came into play from 1 April. There was a breadth of items there, the updated disclosure requirements, there's kind of additional significant capital expenditure we're talking about, disclosing kind of former franchisee details is now explicitly linked to privacy obligations and notifying them, as well as no key fact sheet, which was one of my personal wins from the new code. There was expanded restrictions on the restraint of trade provisions. There's now some of the double penalties in there. There's kind of penalties for having it in there, as well as penalties for exercising restraint of trade clauses, expansions to, what legal costs can be passed on. This follows on from those changes that were made a few years ago, where we're trying to restrict the legal costs franchisors are passing on to franchisees. We've seen expanded termination rights, specific ones for Fair Work, not super surprising given how Fair Work and franchisors have been interacting in the past few years. The opt-out provisions for disclosure in very specific circumstances, which we do go into in more detail in our earlier webinar, and kind of the expanded powers of the ASBFEO in relation to disclosing details that relate to different disputes and those kind of issues, which are things to be aware of. And importantly, most of the obligations in the code now do have 600 penalty units affixed to them, which is really the main thing to be aware of here. That's $198,000 at its maximum for each instance. So if we're talking about restraint of trade amendments from 1 April, you could be in a situation where you're breaching 2 provisions of the code just by having a non-compliant restraint of trade clause in your franchise agreement. So really important everyone is across those, particularly as a franchisor, and comfortable with your current wording. And an overcap of the franchising code overall, something everyone should be aware of from 1 April, as per the standard status quo, it applies to all franchise agreements as defined in the code, except if there's specific industry codes that apply. Does still apply to those food and grocery code or unit pricing code agreements, but otherwise the most particular instance we see is the oil code. It wouldn't apply in that instance. The new regulations have, adopted now the regular legislation structuring, which is a useful change for us as lawyers. Kind of the schedule numbers instead of clauses, section numbers instead of clauses, and schedules instead of annexures. And we've kind of just seen a tightening up as to what a franchise would be considered. So some certain pre-existing business relationships won't be governed by the code. The circumstances there are very limited. So it's more, there's a few criteria to meet. But if you do think that your business might not actually be a franchise under that code, certainly speak to a lawyer and watch our earlier webinar where we explored that. Also, under the code, all disclosure documents as per the standard status quo have to be updated by 31 October. So that date is looming. Some of these 1 November changes you should be thinking about as well as to how you'll roll out that new disclosure document moving forward, particularly if we're talking about specific purpose funds. The key changes, the other key changes to the code in November, which we'll be talking to today, are the compensation for early termination, which Cameron will be delving into momentarily, and the reasonable opportunity for return on investment. These are both motor vehicle dealership protections that now apply to all franchises. So if you're a motor vehicle franchisor, you're probably aware of those. There's the additional capital expenditure disclosure requirements, which will apply from 1 November, and the specific purpose fund requirement that I have foreshadowed. To take us through a snapshot of what those compensation for early termination provisions require, where they are a bit meaty, I'll hand over to Cameron.
Thank you so much for the introduction, Annalise, and for covering a lot of content for a lot of changes to the laws very succinctly. So one of the things we've been keeping a close eye on this year is the new obligation for franchisors to provide a framework for providing compensation to a franchisee if the agreement is terminated early, before it expires. And as Annalise mentioned, this was one of the protections that already applied to motor vehicle dealerships since about 2021, but has now been expanded to all standard franchise agreements. Now, it's not all circumstances for early termination. The 3 situations where this compensation framework will apply is where the franchisor withdraws from the Australian market, or it rationalizes its networks, or it changes its distribution model. Now, you might be thinking, what do those terms actually mean? And if you're thinking that, so are we. There has not been as much guidance from the ACCC or from Treasury or from the drafters about exactly how this works. We might get some more information, but the key takeaway for franchisors is that if you're looking at closing the network completely, or you're radically changing it so that it's not really the network that it used to be when a franchisee joined, that should be a red flag for you to think about whether from 1 November onwards, would you need to compensate any new franchisees that have joined or renewed their agreements after 1 November. So it's something that won't apply retrospectively to existing franchisees, but if they sign a new agreement or there's an extension or renewal or a transfer, then you must have this framework inside the agreement. This might end up leading to some disputes, especially over interpretation of when it applies or not. So it can be something a bit more controversial. Now, to explain what this is, I've actually pulled together some sample clauses because they're really kind of 2 elements of the compensation framework. One talks about compensating for what I've called business goodwill, and the other one is an obligation to buy back stock and equipment that was required to operate the franchise. So I've split these 2. And on the next slide, I'll start with the sort of business goodwill. Again, I'm not going to go into this slide in too much detail, but after the webinar, feel free to delve into it and have a look at how you might want to integrate it. But what the code says is that you must specify how compensation will be determined. And our view is that you need to be a bit specific with what factors you include, but not just things you might consider, but the actual formula, how you're actually going to calculate it, because this is important for the franchisee to know before they sign the agreement. So here's an example of how you might try and calculate the business compensation. You might say it's going to be based on monthly profit. Now, whether you choose net profit or gross profit or operating profit, that's one way to look at it. You could choose to look at this at revenue instead. But as an example I put here, it's monthly profit times the amount of months that are remaining in the term of the franchise agreement, usually just the current term, but could also be the future term. And you do this kind of an average. The compensation here is meant to cover the franchisee that if the network was going to continue and they were going to sell it to a third party, they might use this kind of multiple formula for selling the business independently. And one point on goodwill, the Mercedes case, which we talked about in our earlier webinar, did distinguish between accounting goodwill and legal goodwill. Again, there's a bit of a line being blurred here where the goodwill that you're paying to a franchisee is not for the franchisor's goodwill, but it's almost a lost opportunity to sell a business as well. Now, on the next slide, I do have a slightly different calculation method, which uses earnings before interest, tax, depreciation, and amortization. It's just a different calculation method. And again, how far you go back, whether you do it on a 6 months, 12 months, 12-month, 24-month average, and then multiply that forwards. Again, what's important here is that you specify the calculation method in our view, because that's how you comply with the code for that aspect. But how you actually define it is up to you. Now, one thing that the code is quite specific on is what factors you need to refer to. So on the next slide, I've put together a table which pulls the 4 items for this business goodwill compensation that the code says you have to have specific regard to each of these items. So it doesn't mean you have to include them. It doesn't mean that you have to factor them into the actual compensation calculation. You just have to be clear that you are either including or excluding these items. That's how we've interpreted this. As I said, there might be more guidance coming out from the ACCC or Treasury, but the approach that I've set out here is that if you are going to factor one of these items in, for example, indirect revenue, you should mention that. If you're going to exclude indirect revenue for the purposes of calculating profit, then you should be specific with that. That's how, again, you'll comply with the second aspect of it. And there might be provisions there where you say, actually, we're not going to consider this as part of the compensation calculation. For example, capital expenditure, you might say that's not factoring in it because they will, that was going to be required regardless, it was part of renewal, or the winding up the business costs, you might say that that would be incurred in any case. So we're not factoring that into the profitability of the business. But you also might decide that we are going to include winding up costs and maybe look at capping it. So there's lots of different ways you can approach this. Try to distill this into as little as possible, but it does require you to sit down and have a look at what's the appropriate calculation methodology for our business. So that's the business compensation, what I've called the business compensation aspect. The second obligation on the next slide talks about the stock and equipment buyback. Now, the change to the code said that the franchisor must accept the return of a franchisee's stock and equipment, not all stock and equipment, but certain stock and equipment, and you must compensate them according to criteria that you've set up. So these are the 2 topics that the code talks about. One is outstanding stock that was required to be used in the business. And the second one is specialty equipment, franchise branded products, and merchandise. Now, again, there are multiple methods for how you calculate this. Maybe do an original purchase price or invoice price or fair market value or resale value. What's important here is that you give an answer to how this is going to be calculated on, but the actual calculation method you choose can be up to you. I've also put a suggestion here that if you already have a buyback clause in your franchise agreement, which most agreements do, for example, in a right of first refusal clause, you might say, we're going to use that same methodology, because that methodology probably has details of, we'll nominate a fair price. If we don't agree on a price, we'll go to independent valuation and work through this together. So that's just a high level example showing some of the changes you could do. And then on the final clause, sorry, on the final slide, I've put some extra comments here for something for franchisors to be aware of. There is a section in the a new subsection of the code that says you can't exclude compensation the franchisee would be entitled to. So you need to be very careful about how you limit compensation. But I have put some ideas here for how you might add some conditions or warranties or requirements, called them preconditions for compensation. For example, if the franchisee sells the business and sells the assets to an independent operator or to another franchisee, then they're obviously not going to be buying it back from them. They've already sold it. So there's no reason to pay them double compensation. If the franchisee says, actually, can I keep the stock? The franchisee isn't forced to sell it back to the franchisor. It's just the franchisor, you have to accept it. But when you think about the value of it, think about anything that's damaged, spoiled, broken, expired, that might be a factor you consider. So again, this is not an exhaustive list of things to consider. As I said, you should tread carefully, but thinking about how this framework will actually apply to your agreements is important. And then that final clause that I've put there is about the timing for payments. Again, the code isn't prescriptive about when the compensation needs to be paid. I would recommend putting some timing around it. Maybe it's within a number of days or months of the actual end date of the franchise agreement, but being mindful that you might actually need inputs from third parties, or you might need the franchisee to provide financial statements, especially if you're going to look at things like amortization and depreciation. You may need provision of documents, and it's important to make sure that you're not breaching the code by not paying the franchisee, but there's also a clear expectation that to get the right amount of compensation, there will need to be some time and some number crunching looking at documents. So that's all on the compensation-related termination framework. I know that's a lot to take in, but have a look at the slides afterwards to get a bit more details. So now I'll hand over to Annalise, who's going to run us through the reasonable opportunity for return on investment.
Yes, and this is another provision, as Cameron had said, these already applied to motor vehicle dealerships, which is somewhat helpful, and we have some guidance there as to how these will be applied, at least in that context. These, reasonable opportunity for return on investment provisions now just apply to all franchises. And really what we're talking about here is exactly that, a reasonable opportunity to make a return on their investment. The explanatory statement is quite clear that this isn't about guaranteeing success, guaranteeing profits. We're not trying to remove the inherent risks associated with running a franchise business or any business. It's really just about you as the franchisor now having quite a clear legislative obligation to ensure you've looked at the initial investment, ongoing investment, operating costs. That includes if there's labor, if you're in food businesses, kind of the waste, if there's leases, all of those costs that would be associated, even if they aren't directly related to the franchise agreement or paid under the franchise agreement, but are required to operate that business. And considering all of those factors, you are then comfortable that there is an opportunity that franchisee could return that investment and get to a profitable business position. It is important to note these only apply from, as per the disclaimer there, it's only those agreements that are entered, transferred after 1 November. That is, however, looming. So presumably most franchise agreements that are in the works now might not be signed till after that date. It is important here to note this was already kind of a well-established concept in a lot of case law. Generally, it was a good faith concept that you shouldn't be selling franchises anyway if the franchisee has no opportunity to return that investment. But now with this legislative provision and penalty units attached to it, it's really important that you are going through this assessment process and are comfortable. Some key assessment factors to really think about here is just looking at, generally it's a good idea to go through, as we said, should be section 14 in your DD, but all of that ongoing investment, doing market research as well. It sounds quite obvious, but making sure that the local market research is done as well now, so you can justify where these figures are coming from, justify a realistic level of revenue return for that franchisee, and make sure you calculate in here your royalties if there is a marketing levy, just to make sure that you are comfortable with the term that would be required for them to have that opportunity to pay back that investment and get a return on it. It is really the main like, I guess, cause of these is ensuring that franchisors are granting long enough terms, which is really the second point I've put up there. Once you've done that financial analysis, once you're aware of the costs that are involved in running that business, both upfront and ongoing, that you are making sure that the term is long enough so that there is this opportunity, which in our view is going to be the main action point for franchisors from here. If you do have a slightly shorter term and there is large investment required, there may just need to be a shift in what that term length looks like. It is important to as well think about, in the context of transferring franchisees, how this provision is worded is quite broad, in that, you know, our high level view is if, you know, a franchisee or an incoming franchisee is buying from an existing franchisee a business for an extremely high dollar value, that would likely be considered part of the investment that we're talking about here. So as the franchisor, you would need to consider that, have transparency over prices that existing franchisees are advertising their businesses for, and factor that in to the franchise agreement you ultimately grant to those transferee franchisees. May result, you know, in slightly longer terms for transferring franchise agreements than you normally would provide. But certainly speaking to lawyers, if there might be creative options as well to try and deal with this. But it's really just about now making sure you're proactively aware of those business sale prices and not turning a blind eye to it, and actively factoring that into the ongoing investment that the franchisees are making. In line with all of this, there's, you know, obviously a lot of focus on significant capital expenditure, both in this provision, you know, in calculating early compensation for termination, and the code has actually put some more obligations on how you discuss that with franchisees, both transferees, renewals, and new franchisees. So we will now talk through that and some of the other disclosure obligations that have come into play.
Perfect. Thanks for that, Annalise. So just a reminder, which you should all be aware, but the disclosure document should still contain as much information as is practicable about significant capital expenditure. And this hasn't really changed between the 2014 code, which has been operating until now, and the 2025 code. They've moved some sections around, but the core obligation is you need to put information in about rationale, amount, timing, nature, and anticipated outcomes, benefits, and risks of significant capital expenditure. Now, the kind of capital expenditure we're talking about, we're not talking about consumables, operating stock. We're looking at big purchases of equipment, refurbishment and renovations, rebranding that a franchisee might need to undertake, purchases of a motor vehicle. These are considered bigger purchases, even though the code doesn't exactly say what is or isn't significant capital expenditure. You can use some common sense here, and if it's a big cost, then better to put this in. So the changes for you in the disclosure document is that you now have to, there's now a section to put this in item 14.1a. This is now there where you put all this information there. Previously, you just had to include it somewhere, but it's the same provisions there in terms of disclosing it before franchisee enters into any agreement. Otherwise, you have to get their approval or the approval of the majority of franchisees, or have it as requirement by law if you want to force the franchisee to actually incur that expenditure. And the one thing that has changed most significantly is that the obligation to discuss significant capital expenditure and all those sort of other factors, the rationale, risks, and timing, etc. It was previously an obligation under the code, but now there's a penalty if you don't have that discussion. So you can't just simply say in the franchise agreement that you warrant that we have discussed this. As a franchisor, you must make sure that you have actually had that discussion, that you've actually sat down with the franchisee and said, look, you're purchasing a business in the next 5 years or 10 years. This is what we anticipate might need to be done in terms of refurbishments or renovations. So make sure that that happens. And then on the next slide, just another quick little update on the disclosure document information. When it comes to former franchisees, one of the changes in the 2025 code put in a new provision about notifying former franchisees about that their details might be included in the disclosure document. This is again to comply with the Privacy Act, because it contains personal information such as their name, location, email address, telephone number as well. You should have already done this from 1 April, but just a reminder, since we're coming up to 31 October, you need to, before you include a former franchisee's details in the disclosure document, you need to notify them in writing that they can request to have it removed at least 14 days before you include the details. And if you haven't notified former franchisees, then you should omit their details until that 14-day period has passed. And obviously, if you have a former franchisee who writes back to you and says, yes, please omit my details, make sure that you remove those as well. And there is now a penalty, sort of two separate penalties, one for not giving notice and another penalty if you try and influence the former franchisee to make any choice to include or omit their details. So again, same obligations in terms of influencing, but some extra penalties given the focus on privacy. So that's all on that front. Annalise is going to run through some of the changes for specific purpose funds.
So previously known as marketing and cooperative funds, and it'll probably take all of us lawyers a while to change our language all the time around this, but they've now had a rebrand. And we're talking about specific purpose funds now. Any current existing pre-1 April marketing fund is now a specific purpose fund for the purposes of the code. We've had an amended definition and it is now expanded. So what we're talking about when we're saying specific purpose funds now is any fund that's administered by a franchisor, master franchisor, an associate of the franchisor, where the franchise agreement says the franchisee has to pay money to that fund, and that is used for a specified common purpose, would be considered a specific purpose fund now. Examples that the code gives as to where this might be considered a specific purpose fund would be, for example, IT funds, any kind of software funds. Those kind of items now would be clearly a specific purpose fund and therefore be subject to the same legislative provisions that marketing funds pre-1 April were subject to. Importantly, a disclaimer, it only takes effect from 1 November moving forwards. So if you have some of these funds now, you don't need to provide kind of the financial statements and the independent audit report pre-1 November if they weren't a marketing fund or cooperative fund under the prior code. If they were, you need to comply, but if they are now only captured by this new definition, it's from kind of 1 November, so next year codes update, you will have to comply with these provisions. Essentially, it means all the marketing fund provisions are just going to apply. Everything else is essentially the same. It's just that definition of specific purpose fund. When we're talking to clients about this, there is a lot of, background work to go through and questions to ask. And we have actually seen a lot of funds that we had to actually explore and consider whether it would be considered a specific purpose fund. So some things to really think about here is, is it payable for a specific purpose? A lot of franchisors have annual conference funds that are being collected that would, fall into that first criteria. Are they kind of a regular basis payment upfront? And importantly, is it being mixed with funds from other franchisees? Here, the important point is if you're collecting money from a franchisee that is being specifically spent for that franchisee on a purpose, it would probably be a grey area, and in our view, unlikely if that's a specific purpose fund. It's more so when you're pooling franchisees' money together and then applying that to a specified purpose. It also comes down to your discretion in spending that, which ties into that mixed funding. So it's essentially any fund where people are kind of pooling it together under the guise of, is this for software, and then you as the franchisor have complete discretion as to how that is spent. And this also flows into what would franchisees expect? Are franchisees expecting to understand where those funds are being paid? Would they be annoyed if they were used for another purpose? All of these issues are things that you should be considering in determining if there's a specific purpose fund obligations are going to apply here. We have actually just had a question come in about the specific purpose funds that we'll deal with in the Q&A at the end as well, in the interest of time. But certainly there are likely a lot of these kind of annual conference funds, IT upgrade funds that could be captured here, and it's important that you are, I guess, engaging legal counsel now to work through that. So you can start treating them as specific purpose funds from ideally 1 July this year to make next year's update easier, but at the least from kind of 1 November. In line with, I guess, all those changes, there is a lot of ACCC enforcement in the franchising world as well right now, which is why we've kind of held this webinar and why we're franchising lawyers everywhere are really trying to delve into how this is going to be applied. So Cam will go through at a high level some of the latest enforcement actions and where the funding is likely going to.
Thank you, Annalise. And a very, very good point. There's a lot more scrutiny towards the franchising sector off the back of the independent review by Dr. Michael Shaper in 2023 and the changes to the code. And then earlier this year, we saw an announcement of an extra $7.1 million in funding to the ACCC over 2 years to strengthen their enforcement of the code and education and engagement in the franchising sector. So definitely, as Nicholas said at the start of the webinar, a big year for franchising and something to keep in mind. And I've just put some examples here, just in case you missed it. In June and August this year, there were 3 examples of the ACCC taking actions against franchisors or master franchisees for not complying with their obligations to update the franchise disclosure register. Now, these weren't legal cases. These were infringement notices where the ACCC sends a notice saying, we think you've breached the code. Here, there is a fine attached to it. Do you dispute it or do you pay the fine? Now, these 3 businesses, Cash Converters, Mobile Travel Agents, and a Harvey Norman master franchisee, they all paid the fines. Doesn't mean they admitted guilt. There's no court judgment, but it's clearly showing that the ACCC is paying attention to franchisors who aren't complying. And on the franchise disclosure register, if you haven't updated it within, it's 2 weeks after the basically the disclosure document update period ends. So if you're 31 October for a disclosure document update, 14 November is your obligation each year to update the register. And if you don't, it will actually say out of date. What I find interesting about this is that the franchisors on this list, some of them, they're different sizes and in different industries. One of them was quite small, only a handful of franchises. The other 2 had hundreds. So that's really important to keep in mind in light of all the changes that are happening, and clearly showing that the ACCC is willing and able to issue infringement notices. And as the Deputy Chair of the ACCC said, maintaining up-to-date information on the register undermines transparency for prospective franchisees and the reliability and integrity of the register. So as part of that transparency, as part of that compliance and the purpose of the code of conduct to really lift the standards of the franchising industry, definitely keep an eye on this, not just for franchising obligations, but we've also seen the ACCC start taking more investigations and even court action for breaches of the consumer law, especially with misleading pricing practices, anti-competitive trading practices, deceptive advertising, NDIS endorsements, and whatnot. So you could be at risk of a few different non-compliances, which is why you should speak to your lawyers and make sure you're on top of this. So thank you for listening. That's all the legal content we want to cover. I'll hand back to Nicholas now for some final comments, and then we'll get into the Q&A session.
Awesome. And thank you, Cameron and Annalise, for running us through that. Obviously, lots to go through there. And as we mentioned, this will be sent through so everyone can review any parts that they found important. Bear with me a second. There we go. Now, one thing that we have updated here internally is our Franchisor Toolkit. It's one of our most used resources. And we've just had that updated with a lot of the sort of material that we've discussed today. So feel free to either take a scan of the QR code on the screen. Again, these will be sent around, but certainly a very worthwhile resource to have in your arsenal. Coming up, we have our next webinar, Avoiding NDIS Pitfalls, Key Breaches and How to Prevent Them. That is, again, happening next Thursday at 11 a.m. Feel free to register through our website, but we will also be sending through an email for that as well. And before we move to answering the questions that you've been sending through, we'd like to take a minute just to tell you about LegalVision's membership. By becoming a LegalVision member, your business gets unlimited access to our full team of over 100 specialist lawyers for all of your business as usual legal needs. So it's basically like having your own in-house counsel, but for a fraction of the cost. Through our membership, we assist with many of the things on the screen here, but specifically a few of the main areas that we assist with is all of your documentation, from drafting to reviewing of your business contracts. You can meet with the lawyers on an unlimited basis and get advice when you need it. We look after all of your trademark registrations in Australia, New Zealand, and much, much more. But basically, as a LegalVision membership, you don't have to worry about the cost of lawyers. Think of it as having your own in-house counsel. We'll take care of all of the business as usual legal work, so you can focus on running your business. If you are a business where you already have an in-house counsel, we also offer a very dedicated service to manage your high volume business as usual legal needs. To learn more about the membership or how Desk Extension can help you, request that free consultation at the end of the call when the survey appears, and we'll be in touch to book in a time to meet with you. Now we're going to hand back over to Annalise and Cameron to answer those questions you've been sending through. Whilst they're doing that, you will also see that poll question pop up on your screen, and we'd appreciate if you could answer that. Over to yourselves, Annalise and Cameron.
Perfect. Thank you, Nicholas. We had a fair few pre-submitted questions, but I'll just answer one of the questions we received live through the webinar. So it was about whether something would be considered a specific purpose fund if a franchisor is holding a percentage of invoices for each franchisee as a conference levy, and the funds are held for them for their own use. And at any time, the franchisee can request essentially that those funds are returned to them. This is obviously a very specific, curly question. We would need to ask more questions to this specific person to answer with 100% certainty. But generally, if these funds are being mixed across franchisees, so it falls into that kind of pooled category of I'm collecting these funds for a specified purpose and holding them for multiple franchisees together, then it is likely that this would be considered a specific purpose fund. The kind of item about if you're returning funds to people, or if they have that option to have them returned, that doesn't really play a part in whether something would be considered a specific purpose fund or not. So really what we're looking at is, are they kind of mixed? Are they all held collectively for a shared purpose, which this could be argued they do. And then from there, that would be determining whether it's a specific purpose fund or not. On that question, it's certainly something we could answer kind of for LegalVision members on a consult, but certainly worth kind of booking in a consult or speaking to your lawyer about how those funds are held and how they're categorized to franchisees to see if there's a way you can structure it so it either isn't a specific purpose fund or you comply with those terms if that determination falls into that category. We have had a few other.
I'll take this next question. Thanks, Annalise. So we've got a question from Peter about the early compensation framework, which is a very good question, Peter. So thank you for asking that. The background to the compensation framework comes from, there was a circumstance of Holden withdrawing from the market in 2020 after they stopped manufacturing in 2017. And this caused a lot of disruption for franchisees who had invested a lot of money into those motor vehicle dealerships, and then which are typically for much longer terms than standard franchise agreements, as you'll probably be aware. And then those franchisees kind of being left in the lurch. So that's why we saw the compensation framework start with motor vehicle dealerships and now also be rolled out to the rest of the industry. The specific provisions, it does obligate the franchisor to give the compensation, which you're right, is a change in the franchise landscape. And even though there is no contractual right to simply terminate in most franchise agreements, some of them do, you might see situations where the franchisor actually closes the network and say, look, we can't operate this. It's not feasible. That's what General Motors did with Holden. They said we just can't operate anymore. We can't compete. It's too expensive. You can also see situations where there might be changes to the law and the franchisor actually can't operate the business model because the method they were doing maybe became illegal or it's too regulated and they couldn't do it. Or might see situations where you have a sub-franchisor or a master franchisee in Australia who loses the rights to operate a network under an overseas-based franchisor's brand, and therefore they have no choice but to close the brand in Australia. So there could be these circumstances where this closure is forced. I don't think we're going to see many situations where a franchisor simply phoenix their networks and come back around. That would be definitely in breach of the good faith obligations. But there is, under the old code, under the current code, there is still a section, it was clause 20 under the old code, where if a franchisor wanted to give notice to terminate the franchise agreement where there's been no breach by the franchisee, they had to give reasonable notice. And that was section 56 of the new code. That was effectively where there was no contractual right to terminate, but the franchisor was having to close the network anyway for maybe some of these other factors, and said that the franchisee didn't accept or give their consent to the termination automatically, and then they could go through a dispute resolution. So we've just seen an expansion of that, because there might be market circumstances where a franchisor cannot operate anymore, and the code isn't going to force a franchisor to operate when it's not feasible for them. But it's a very good question. Happy to chat more about this if you want to book a consultation with us. And a quick little plug, I'm actually taking part in a panel next week at the Franchising Council Network, so we'll delve into these in more detail. We had another question come through, which is, what is the biggest surprise for you as a lawyer in the new code? I'll try to keep my answers succinct on this. I think Annalise and I agreed. One of the surprises is that they still had sections that applied to the same topic quite far apart. Some of the restraint of trade provisions, the prohibition on having a certain clause that doesn't comply and using it, they're quite far apart in the code. Similarly, with the specific purpose fund for the obligation to maintain certain accounts and the obligation to do the reporting at audits, they're not consecutive. They're far apart, which makes it harder for franchisors to understand their obligations, and also for franchisees to understand their rights. And more generally, we think there is a missed opportunity to simplify some of the wording in the code, especially when it comes to even the prohibition on excluding compensation. That wording it's not very clearly drafted. So we are hoping for some more clarity from the ACCC or the Treasury, even something as simple as what is rationalize the network or change the distribution model. As lawyers, we can speculate what this might mean, especially when you think about in the leasing context, a derogation of grant is something that's so greatly different from the transaction that was entered into at the start. But this is just conjecture. So we don't really have as much guidance on that, and getting some more clarity over what is a reasonable opportunity versus an opportunity. And as Annalise mentioned, the scope of the initial investment for franchisee, where is the line? We're surprised that they didn't put that in, because since 2021, franchising lawyers working in the motor vehicle industry had already been saying and giving feedback, asking for more clarity on this. And as part of submissions to Treasury, when we had the draft exposure code come out, I know both LegalVision and many other law firms, as well as probably franchisors, requested some clarity over this. So it was a surprise that that wasn't put into the code as part of this process, which would have made our lives a little bit easier and everyone in the industry. But thank you for that question, whoever submitted it. Annalise, I think there was another question for you about marketing funds.
Yeah, so we also were asked, like, what options are there for unused marketing fund balances at the end of each kind of trading year, financial year? The most important thing here is you don't need to spend all the money. You don't need to spend all the contributions of the marketing fund in one financial year. Really, this comes down to those pre-existing obligations in relation to reporting just what is in that fund. So if there is a surplus, you need to make sure that that is disclosed to franchisees quite clearly in those financial statements that have to be provided to all franchisees, including your existing franchisees, within 30 days of being prepared. That should be setting out what that surplus is, and you can also set out what it will be used for if you would like, in that fund, or in general discussions, in your annual conferences, be talking about different marketing initiatives that you are considering doing with that surplus. That's not a requirement, just something, given the extra scrutiny around marketing funds, specific purpose funds, it's always better to be more transparent than less in our experience. So that can just stay in the account. Just make sure it's accurately disclosed in financial statements. I think we did have a few more questions, but we won't have time to go through those today. So I might just hand over to Nicholas and he can wrap up, and I guess, again, let you all know about consults, which you can book in and we can answer those unanswered ones there.
Absolutely. And thank you, Annalise and Cameron, again for the webinar material and for answering those questions that were sent through. Unfortunately, that is all we have time for today. If we haven't answered your question, feel free to submit some more questions in the survey that will be at the end, or book in a consult with us so that we can address them personally for you. But yeah, whilst this is a free webinar, we value your feedback. So when that 30-second survey appears at the end, please tell us your thoughts and opinions, and so we can keep making these as valuable as possible. But until next time, we'll see you at the next webinar. Thanks for joining us.
Thanks.
Thank you so much.